I think it's a pretty good buying opportunity. I looked at the low versus the high. I think it came out 9.3%. 9.3% is a perfectly normal correction. You don't even have to sweat about it. I mean, these things happened during the 2009 to 2011 major bull run at the end of the gold bull market in those 2 years. And so what are we sweating about a 9.3% correction? It's a little bit more frustrating when Bitcoin reaches like 95,000 or whatever it's at. And that's great. I mean, I hope Bitcoin is money. I don't think it is, and I'm happy if you're a liberty-minded person who has a lot of money now. That's great. Just be careful with it and lock some of it away into an asset that has 5,000 years of history instead of just like 15. It's what I would do. Is this the bottom? We don't know. I don't think gold's going to go off to the races until the next printing round starts. It could stop. We could stop the decline here, and we could head steadily higher on a stair-step way, like we did in the end of the last bull market. I think that's what's going to happen. But again, like if you've been buying every month and you've been buying, a certain dollar amount every month for the past, year. Does it really make a difference if you got in at 2,800 and then you buy another tranche at 2,550 and then next month it's 2,700? Like, who cares? We've got to stop looking at the dollar price. The dollar price doesn't really matter with gold. It matters with Bitcoin. If Bitcoin doesn't keep going higher, I think people lose interest. But nobody's ever going to lose interest in gold. It doesn't make any sense. But keep in mind that we're in a system where debt equals money, right? That's not just a saying. That's transitive property. Right? If debt equals money, less debt means less money. Less money means it means banking crisis, crash, stock market crash, whatever accompanies a financial crisis. We're all familiar with it. So if he stops the debt, he stops the money, and then you have a crash. So okay, if he cuts spending radically by $2-3 trillion, whatever you want to say, there's going to be a crash. You can't change the laws of economics. You can't change the laws of the Austrian school business cycle, right? That's a law that was discovered by Mises, uniting microeconomics with macroeconomics in the single system. It's like the grand unified theory of economics, you could call it. And he's not going to get around that. He's not going to break the law of gravity, right? So you have to continue to stack gold and silver if that's what you've been doing. Continue to do it responsibly. A fixed amount every month is probably the best way to do it and not worry about prices. And what I would say though is that we had two choices coming into this election. We were going to either head into the end game dirty, or we were going to head into it in a more cathartic. Let's remember who we are as Americans, as the West, what made the country great, and come back to the good that's left here before we have to deal with this stuff. And that's what's going to happen. We're going to head into the end game. We're going to head into a monetary crisis. Everything that we've been predicting is going to happen. It's just going to happen with a little bit more of a sane polity. A group of, a country that has more of a head on its shoulders, and it recognizes, for example, basic biological, maybe gets itself a little bit more healthy, and we are able to find out who's on the Epstein Black Book or who killed Kennedy or whatever these nagging questions are that have been haunting Americans for decades. Maybe we have a chance of uncovering them now. And if nothing changes, then we'll know that voting is a sham completely. Because if ever there was going to be change, it's going to be now or never. I mean, it seems logical to me, but this is new territory for everyone because we've just entered a bond bear market for the first time since 1981, and so it's new for all of us as traders, unless you're 70s, 80s, maybe late 60s. So what I found is that rising long-term bond yields like 10, 20, 30-year treasuries hasn't happened together with a rate cutting cycle since 1981. Looking at the Fed funds rate, and every time it went down, every time the Fed started cutting, what happened to long-term rates? And since 1981, they've always gone down. There was one little possible exception in 2008, but it wasn't really an exception because, there was a short period in 2008 from about March to June when the Fed wasn't cutting. And during that time, the 10-year yield went up. I also looked into why that was. And during that time, actually, most people are not aware of this because we equate 2008 with the start of QE and bond buying and money printing, but wasn't exactly that way. The Fed was expanding its balance sheet beginning in mid-2008, but it did that simultaneously with selling U.S. Treasuries because it was trying to balance things out. There was still some semblance of let's not be too dovish or liberal with money printing here. So they were selling Treasuries during that time. So that's a reason why bond yields were heading up while the Fed was holding rates steady. But if we exclude that, it doesn't have to be excluded in my opinion. It follows the pattern. But the point I'm making is that we haven't had sustained rise in long-term Treasuries with a Fed rate cut since 1981. And before that, there was one time in 1974. It was like 3 or 4 months in 1974. Before that, 1969, 1970, and that's as far as the Fed data goes. I'm sure if we have some wonky people watching this, they can go research rates. When was the time before 1969 that the Fed cut rates and long-term bond yields were up? I'm sure it happened maybe around World War II or something, maybe once in the 50s, once in the 60s, but check it out. Comment it below if you find any more evidence. But I think I have enough evidence to say that if the Fed is cutting and long-term bond yields are rising anyway, then we're in a bond bear market. Because if we took those 3 data points, 1969, 1974, 1981, those were all bond bear market. 1981 was the tail end of the blow-off, bottom or top of the bond bear market, depending if you want to look at bond yields or bond prices. And then since then, it hasn't happened. So this is another confirmation that we're in a bond bear market, which means interest rates are going to go higher and higher and higher. And the only way the Fed can stop it is basically by buying the entire bond market, which is basically what the Bank of Japan has done. But the Fed can't do that because that would destroy the dollar, because the Bank of Japan is not in charge of the world's reserve currency, whereas the Federal Reserve is. So they can't really buy the entire bond market. That would make the dollar worthless. And by extension, every other fiat currency. So that's basically where we're headed. There's no escaping from it.